40 years of work, $18,000 in a retirement account, and a note on the refrigerator. Mom is moving in with us. This is not a movie plot. This is the real story of Linda Morales from Sacramento, California, 66 years old. She retired in 2025, and she discovered that retirement is not a rest. It is survival. In her bank account, $18,000. Credit card debt, $45,000. Mortgage not paid off. And her Social Security check covered 60% of her monthly expenses. Linda is not an exception. She is a statistic. According to the Federal Reserve, 1 in 4 Americans over the age of 65 has less than $50,000 in their retirement account. And debt? For those retiring with unpaid mortgages, car loans, and credit cards, total debt easily exceeds $100,000. In the next 20 minutes, you will understand why this happened, what specific mistakes led to this, and what everyone between the ages of 35 and 55 can do right now to avoid ending up in Linda's position. Linda started working in 1983. She was 24. Her first job was administrative assistant at an insurance company in Sacramento. Her salary was $14,000 a year. For that time, it was decent. The employer offered a 401k, a retirement account through the employer with matching. The company added 50 cents for every dollar Linda contributed, up to 6% of her salary. Linda declined, not because she did not want to, but because she did not understand. She was 24. Retirement seemed like something from another galaxy. Why save for old age when rent was $400 and she had $40 in her wallet? Sound familiar? Here is what matters. Linda was not irresponsible. She worked without a break. 40 years. She changed 5 companies, paid taxes, raised 2 children, divorced at 41, worked weekends on the side. She did everything right by the standards of ordinary life, but not by the standards of retirement math. Here is a number that will determine whether you close this video or watch it to the end. If Linda had started putting just $100 a month into her 401k at age 24, with employer matching and historical market returns of about 7.5% after inflation, by age 66, her account would have held more than $500,000. $500,000. Instead of $18,000. Remember this gap, it will come back later. Linda first thought about retirement at 45. Her children had left for college. The divorce was behind her. Her salary had grown to $48,000 a year. Then she saw an advertisement: open an IRA, an individual retirement account, and get a tax deduction. She opened one. She deposited $2,000. And that was it. Why? Because that same year her car broke down. The repair cost $3,800. She used a credit card, then a new roof, another card. Then she helped her son with a security deposit for an apartment. Each time, she told herself she would start saving next month. That next month did not arrive for 21 years. This is where Linda's story stops being a single case and becomes an epidemic. According to the Federal Reserve, the average credit card balance for people aged 55 to 64 is more than $9,000. The average interest rate is about 22% annually. Now do the math. $9,000 at 22%, making only the minimum payments. Do you know how long it takes to pay it off? 27 years. And the total paid is more than $24,000. For an original debt of $9,000. Linda had 3 such cards. Her total balance was $45,000. Minimum payments consumed $780 per month. $780. Every month. For years. This was money that could have been sitting in a 401k growing. Here is the irony. The safe choice, paying the minimum and not touching savings, turned out to be the most destructive. Linda paid 22% to the bank instead of earning 10 to 11% in the market. Over 40 years, Linda changed 5 employers. 4 of them offered a 401k with matching. Linda did not take advantage of any of them. This next part is painful. According to Fidelity data from the 4th quarter of 2025, 88% of employees with 401k plans received employer matching. The average employer contribution was 4.7% of salary. This is free money. Literally, the employer puts dollars into the account, and the employee only needs to check a box on a form. Let us calculate the scale using Linda as an example. Her average salary over her career was roughly $35,000. Matching at 4.5% is about $1,600 per year. Over 40 years, that is $64,000 in pure employer contributions, without any market growth. With compound interest over the same 40 years, that amount would have grown to between $250,000 and $300,000. $300,000. The price of a home in Indianapolis simply disappeared because a box on a form was never checked. What hurts the most? Linda only learned about this at age 57, when an HR manager at a new job asked, "What percentage do you want to contribute to your 401k?" And for the first time, Linda answered, "The maximum." Let us step back from one person's story, because Linda is not an anomaly. She is the median. According to Fidelity, the average 401k balance in America at the end of 2025 was $146,400. The median was $34,400. These sound like two different worlds. That is because they are. Do you feel the gap? The average is $146,000. The median is $34,000. This means a small number of people with millions pull the average upward, while the typical American sits on $34,000 and thinks they are falling behind the norm. $34,000 for an entire retirement. The number of millionaires among 401k holders at Fidelity grew to 665,000 in the fourth quarter of 2025. That is a record. But Fidelity's database holds 24.8 million participants. Millionaires are less than 3%. The other 97% are somewhere between Linda and the dream. Now comes what appended all of Linda's calculations, and what could append the calculations of anyone who is counting on Social Security as their main source of retirement income. Linda counted on Social Security as her safety net. She is not alone. According to EBRI, the Employee Benefit Research Institute, about 40% of retirees call Social Security their primary income. Linda's check is $1,620 per month. The average payment nationwide in January of 2026, according to the Social Security Administration, was $2,071. Linda receives less than average because she worked off the books for several years and had years with zero income. Her monthly expenses are $2,700. Rent after selling the house, insurance, food, medications, minimum credit card payments. The deficit is $1,080 every month. With a balance of $18,000 in savings, this money will last 16 and a half months. And then it is gone. Reality turned out to be far harsher than the calculator showed. And here is why Social Security alone cannot be the only plan. Now let us look at the bigger picture. Not just Linda. The Congressional Budget Office, the CBO, projected in February of 2026 that the OASI Trust Fund, the retirement trust fund that pays benefits, will be exhausted by 2032, 6 years from now. Let us be clear. This does not mean checks will stop. Even after the fund is exhausted, payroll taxes continue to come in. But they will only cover 77% of promised benefits, an automatic reduction of 23%. 77%, not 100. For every dollar you were promised, 23 cents simply disappear. This is not a collapse. It is an automatic reduction to the level of incoming taxes. According to the Social Security Administration's Trustees Report for 2025, the date is slightly later, 2033 for the OASI fund. Estimates differ slightly, but the direction is the same. Several factors accelerate this timeline. The Social Security Fairness Act, signed on January 5th of 2025, repealed the WEP and GPO rules, which had reduced benefits for former public employees and teachers. This was a fair decision, but it became the main factor shifting the exhaustion date forward. The CBO also projects lower trust fund revenues due to reductions in income and payroll taxes. And every day, about 10,000 baby boomers turn 65. 10,000. Every day. Linda retired at 66. At 67, full retirement age, Medicare is already active. And here is the quiet hit to the wallet that strikes softer than debt but cuts deeper. The Medicare Part B premium in 2026 is $202.90 per month. That is an increase of nearly 10% in a single year. Meanwhile, the Social Security Cost of Living Adjustment, or COLA, was only 2.8%. The government's increase was less than 3%. The cost of health insurance rose nearly 10%. Can you see where the money is leaking? This is the base premium. For those with income above a certain threshold, depending on tax filing status, an income-related monthly adjustment amount, or IRMAA, applies. Linda is not affected because her income is too low. But for those planning Roth conversions in retirement, and we will discuss this in a moment, IRMAA can become an unexpected budget shock. Imagine this: you are 65, you are retired, and ahead of you is a bill for $250,000 just for doctors. According to Fidelity estimates, a couple retiring at age 65 will spend approximately $330,000 on health care over their remaining lifetime. That is like a second house. The key to this entire story is not an investment strategy. It is arithmetic. Simple arithmetic. Two people. The first, let us call him David Chun from Austin, Texas, starts saving at 25. $300 a month into a 401k. Historical market returns average about 7.5% after inflation. By age 65, his account balance reaches $1,100,000. This is a hypothetical calculation, but the math is verifiable. The second, Linda, starts at 45. Same $300. Same market returns. By age 65, her account balance is $178,000. $1,100,000 versus $178,000. Identical monthly contributions. Identical returns. The difference is 20 years. And more than $900,000. $900,000. For 20 years of inaction. That is the price of the phrase, I will start next year. But here is what needs to be understood, and this is where Linda made her second mistake. She decided that starting late meant starting was pointless. That is not true, and the next 4 minutes will show why. Let us forget about Linda for a moment. Let us talk about those who can still change their trajectory. Suppose you are 38. Your salary is $65,000. Your retirement account balance is $20,000. It seems small. Let us calculate. In 2026, the 401k contribution limit is $24,500. That is the maximum you can put in from your salary. Suppose you cannot reach that. But 10% of your salary, $6,500 per year, is realistic. Add employer matching of about $3,000. That totals $9,500 per year. With a return of 7.5% after inflation, by age 67, your account balance exceeds $800,000. Starting from $20,000, on a salary of $65,000. Now suppose you are 52. The standard $24,500 plus an additional $8,000 for those over 50. That totals $32,500 per year from your salary. But there is more. If you are between 60 and 63, the Secure 2.0 Act opens a special window. An additional $11,250 above the base limit instead of the standard $8,000. Not in addition to, instead of. The total is nearly $36,000 per year from the employee alone. Fine print in the tax code worth hundreds of thousands of dollars. Another tool Linda never heard of in 40 years of work is the HSA, the health savings account. Sounds boring. It works like a rocket. Triple tax advantage. Contributions are tax-free. Growth is tax-free. Withdrawals for medical expenses are tax-free. No other account in America offers this. In 2026, the limit is $4,400 for an individual and $8,750 for a family. After age 55, an additional $1,000. And thanks to the One Big Beautiful Bill Act signed on July 4th of 2025, bronze and catastrophic medical plans now also provide access to an HSA. Previously, only a high-deductible health plan qualified. And the Roth IRA, Contributions are made with after-tax money, but withdrawals in retirement are completely tax-free. And, pay attention, Roth withdrawals do not increase your income for IRMAA calculations. They do not increase the taxation of Social Security benefits. They are not subject to required minimum distributions. A Roth account provides powerful advantages in retirement. However, if your current income exceeds $150,000 and you expect a significant drop in retirement, a traditional 401k may save you more through current tax deductions. There is no universal answer. The calculation depends on your specific situation. Speak with a planner. Numbers do not lie. Here is what the calculator shows for anyone who starts acting today. Action 1. Open your 401k statement or log in to your provider's website. Check whether you are using your full employer match. If you are not, you are literally turning down free money. According to Fidelity data, 88% of employees with 401k plans received matching by the end of 2025. But previous company data showed that about 22% of employees did not contribute enough to receive the full match. Do not be among that 22%. Action 2. Check your fees. Look at your portfolio composition. If a fund's expense ratio exceeds 0.75%, look for an alternative. The difference between an expense ratio of 0.03% and 0.75% over 25 years on a portfolio of $300,000 is more than $185,000. $185,000 simply for choosing the wrong fund. Action 3. If you are over 50, make sure you are using catch-up contributions. An additional $8,000 per year for those 50 and older, or $11,250 if you are between 60 and 63. And this is instead of, not in addition to, the standard catch-up. Action 4. Pay off debt with an interest rate above 10% before increasing retirement contributions beyond the employer match. A credit card at 22% consumes any investment return. The math is unforgiving. 22 minus 7.5 equals a net loss of 14.5% every year. Action 5. Open the Social Security calculator on the SSA.gov website. Enter your information. Look at the difference between claiming at 62, at 67, and at 70. This difference is enormous. The maximum benefit at age 62 in 2026 is $2,969 per month. At 67, $4,207. At 70, $5,181. That is roughly 24% more than claiming at full retirement age, for waiting 3 years from 67 to 70. And if you compare 62 to 70, the difference is nearly 77%. But waiting is not for everyone. Health, other sources of income, family situation all play a role. This is why you need a CFP, a certified financial planner, specifically a fiduciary, someone who is required to act in your best interest, not earn a commission from selling a product. Linda sold her house. She moved in with her daughter in Austin. Her credit cards are on a restructuring plan. Social Security is her only income. 40 years of work. And a note on the refrigerator. What about Linda? She wrote down a website for her granddaughter. SSA.gov. Her granddaughter is 26. The best age to start. This story is not about Linda. It is about the math that works the same for everyone. Compound interest does not ask your name. It does not check your diploma. It needs only one thing: time. If you are 35, you have 32 years. If you are 45, 22 years. If you are 55, 12 years. Even 12 years with maximum contributions and the right strategy can yield hundreds of thousands of dollars. One question in the comments is simple. Which of the 5 actions will you take first? Write the number 1, 2, 3, 4, or 5. And if this video gave you at least one thought worth your time, a like and a subscription will help show it to someone who needs it right now. Everything said in this video is educational content. This is not financial, tax, or investment advice. Before making any decisions, consult with a certified financial planner or tax advisor.